Hello everyone, welcome to the percentage band rule trading strategy built on dual exponential moving averages, DEMA for short. My name's Darren Maddox and I'm excited to share this with you today. It took a lot of work during my dissertation, hundreds of hours of backtesting and design to get the best outcome. Okay, first things first, a mantra that stuck with me from my trading teacher, and he always says, you can give people the rules to make money, but most will not be capable of following them. And such is the world of trading. The battle is not the strategy itself, it is your ability to stay disciplined, not deviate from the rules, and be a signal execution machine. This is the difference between success and failure, as I discuss in the Risk Management 104 video on market psychology. You must trust your edge. If you haven't done so already, watch my video on exponential moving averages basics, as this will help you understand this video. Now, the goal of this day trading strategy is to choose one asset for which you will almost always be in a position, whether long or short, to ensure you catch every trending move while avoiding as many fake outs as possible. Forex has longer opening hours and a lot of liquidity, so it's a good option. I'm going to demonstrate on the recent Euro US dollar 1 hour price action. And remember, stop losses and break evens are an important part of every strategy, and note that this strategy provides greater profits in trending markets and promotes survivability in ranges. So go ahead and add in your EMA 5 and EMA 12. I've set my 5 to yellow and 12 to blue, 5 being the fast EMA and the 12 being the slower EMA. 5 and 12 were optimal in every single combination test that I did. Okay, I'm going to show you the basic principles of the DEMA strategy and what we're looking out for. So we're looking for the yellow lines to cross the blue line. That signals it's time to set your limit order at the yellow line, with the idea that the next candle comes into the yellow line, fills your order, and is rejected, creating a new trend, like a test of resistance or support. Your stop loss just slightly above where it's crossed over. You go 1 or 2 candles back and look for a swing wick. So your stop loss is pretty tight. Your cross has happened. Your limit order's filled here, and you take profits. Now there's 2 ways to do this. Take profit 1 is always at the previous swing low or high, depending on the direction you're trading. The second time is when the yellow crosses in the opposite direction. You close out the trade. The idea here is often you don't get the full 1% stop loss hit because your trade will be closed out earlier. Here you would, but the point stands. So you get an opportunity to get out earlier during ranging markets, making perhaps a few small losses before you win the big ones. The big ones really make up the profits in this. You'll be getting 20 RR, 30 RR. Some crazy outliers are removed from the work, with like 70 RR. If you're programming an AI to do it, you can make these kind of gains, but you may not get them doing it manually. An algorithm, not an AI, sorry. So I'll show you again in practice with our short tool. We cross here. It will be this one because this is still touching. So you cross here, you set your order at the yellow line, which gets filled against the swing high just above the crossover. You always take your first profit here for those risk averse people, which is about 50% of the trade, or you can just ride the bands down now until they cross here. So your profit would be closing out on that candle. That one trade would give you a 7.93 RR. You would go long here. When the candle touches the yellow line, just slightly under it there with a take profit of here, that would knock you out. Fine, you lose 1%, but then you get your next opportunity almost straight away here. You cross, touch the yellow line roughly about there where your limit order is, with a stop just above where the crossover happened, and you get to ride this one down again till it crosses just here. In this high volume node, you always want to be out during them anyway because reactions are pretty strong. It's pretty much the only thing I'll keep on for this trading strategy is the 2 EMAs and your high volume nodes, which you can identify on the daily time frame. I've showed you how to do that in the previous videos. So again, you'll get out not on this candle but on this candle, so roughly around here you got another 4 RR. So far, just on the previous couple of weeks of Euro US dollar, you've made a 7.9 R and a 4 RR and lost once in that day. Now there is some caveats. You can stay out when you're inside these ranges, but I prefer just to leave the system running regardless to catch some of the bigger wins. Now, this candle, you'll miss a good entry because you won't actually be crossed until here. So you won't get in until this point. So let's have a look what happens at that point. You managed to get in here. Where'd you put your stop loss? Aha. Sadly, the rules suggest that it must be very wide on this one. So probably not worth entering. You might want to wait for the next setup. Your algorithm would enter anyway if you set it up, and it would actually make a tiny win of 0.48 on that first take profit I was discussing. But if you didn't take that, then you'd be getting knocked out here, which is still above where you entered, so you still make a little profit on that trade. Now your next opportunity, you're short here. See what I'm saying? You're constantly in the trade. Every time it crosses, you set your limit order, you're in the next trade. This one comes back against you and knocks you out. It doesn't quite get down here, which is you kind of don't want to be entering on these big candles. I'm just demonstrating anyway how it would work. This one would come back against you and you'd be out. Another minor loss, 1% max, offering you a new entry right here. So what happens with this position? Your limit order is filled, your stop loss is down here, and you get to ride this one all the way up to the cross here, 2.28. You can see how this works. It goes on and on. Every time it crosses, you're in a trade, minor profits. Ranges are going to knock you out, not always at 1% no, which is really good. Enter again, knocked out. These little ranges will knock you out a bit. Then you get another opportunity. Let's see how this one pans out. I haven't looked at this data, by the way, so we're just showing you how the strategy works. Crosses here, touches here. So you get in a position there against this. First take profit is the bigger swing low there, so you can take that, or you can wait to get knocked out on a big up candle here, which would knock you out at break even. This is why I like to take 50% and let the rest run, just to make sure I'm locking in profits consistently. Tiny profits, don't go for the big wins. Small profits are what keeps your portfolio growing. Chasing big profits are what leads to a lot of stress and a lot of losses. So next one we've got here. This works on any asset, by the way, on any time frame. You've got your cross, you've got your touch, or the fills against here, and off you go again, ride in the bands. You get your first take profit there if you want that, 1.45, or you could just wait for the crossover rule, which happens to be right there, another 2.16. And you can program this pretty easily. This one, you get entered there, really tight one, just above those wicks. Again, coming down, following the band down. Sorry there, you can't see that. Following the band down. Doesn't quite hit the swing low, so you wouldn't get out that time there. Wait for this band cross here. Another 1.9. Okay. Let's see what happens next. Another cross. Your signal's in. Your limit order's filled at the EMA. Just below there. This one's tight. Doesn't quite hit your swing high again over here. So you wouldn't be taking that profit. You'd be getting knocked out. Probably on this candle here, somewhere around there as that closes for 1.3. But that allows you to enter a short, you see, constantly in a trade, constantly with a limit order set. This opens, you don't get filled till here because that's where the candle touches the 5 EMA. So you always, this is a good bit to look at. Your 5 EMA doesn't get touched. So your limit order needs to move constantly. Every candle close, every hour update there until you get touched. You can get touched here. Fills quite far away this time. Swing low, target here. Doesn't get hit. What happens is it comes back against you and closes you here at a 0.31 profit. Still profiting even when it's coming against you. It works pretty well. It's working pretty well in this range. This one will knock you out. You'll get filled here. And it comes straight back against you and knock you out for 1%. You can see, we're just following it. Always in a trade. What's next? I've lost where I am now. You get the point anyway. Sometimes you get these massive candles like this, which you don't really have the opportunity to get in on. And other times, if you look at the PDF attached below where I've done the work, I've removed the outliers, but sometimes you get these really unusual trades where it's just so tight. It's just so tight like this. And you can just, they just ride up. Especially, you wouldn't maybe not enter that manually. It might look a bit dodgy, but if you've got an algorithm running, these guys can catch some massive moves sometimes, especially around announcement days like the Fed rate cuts and stuff like that. And as I said, this works on all time frames. The smaller the better. As you get down to the minute, 5 minutes, you're getting hit by a lot of fees. So you have to go with an exchange that has a fixed fee structure, like a monthly subscription rather than per trade, because you will get annihilated by fees. You can see all of those back-tested results in the PDF I've linked in the comments. I'd skip to page 38 because it's a lot of research and jargon before that. Yeah, so the backtesting results on this show with the 512 and the 1 hour time frame, you can be hitting 200% plus a year, which is from the compounding mainly. But have a look at it yourself. That is the basics. Now, you're probably thinking, where's the percentage band rule? Well, as part of the optimization, the more advanced stuff. And basically the idea of that is to cut out ranges as much as possible to cut down on your losses. So let's just pick one at random here. The percentage band rule basically states that you have to wait, not just for when it crosses, but to ensure there's a threshold gap, a percentage band gap between the two EMAs. So let's say it's 2%, then if this gap isn't 2%, then it suggests that we're not going into a new trend and therefore does not activate the limit order or close the previous trade. So you may enter down here, as we discussed earlier. You get in there with your stop loss here. Now, normally be knocked out here, but if the percentage gap isn't large enough, then you remain in the trade. Go to the next cross here, If that gap doesn't cross the threshold, then you remain in the trade. It's not considered to be a cross with width, percentage band width. Like I said, this is completely different for all assets, oil, nat gas, different currencies. You have to do back testing, you have to do that regularly to find the current threshold that's going on. It also stops you from entering trades that will get immediately stopped out. Optimal outcome on the euro US dollar 1 hour is no percentage band rule, but that is the only circumstance where that occurs. And that's it. That's the optimization part of it. It increases win rate to just over 50%. Any questions, let me know. Safe trading.